Hello, my name is attorney Wendy Guthro, an estate planning attorney licensed in both Massachusetts and New Hampshire. I'm physically located in Burlington, Massachusetts, but serve all the surrounding areas as well as New Hampshire. So today we are going to be speaking about the new Massachusetts $2 million estate tax exemption. I'm going to bring up a PowerPoint presentation and we'll get started by doing that. And we're going to talk about this new Massachusetts exemption and how it could intersect with your estate. So let me pull up that shared screen. Okay, as I said, it's the new Massachusetts estate tax exemption. And today we're going to speak about how that intersects with your estate and estate planning. As I said earlier, I'm Wendy Guthro. My practice focuses on estate planning and probate and elder law issues. And that I am admitted, as I said earlier, into the Massachusetts and New Hampshire bars, both state and federal. I'm also a notary public. Today, our goal in this webinar is to discuss the intersection of your estate plan and this new Massachusetts $2 million estate tax exemption. We'll speak briefly about estate tax planning for federal and Massachusetts. The new Massachusetts exemption we'll speak about in a bit of detail. The strategic estate planning that can be done for you if you do find yourself close to or over the $2 million planning threshold. We'll talk about whether you need to change your plan based upon what your current estate plan looks like. And then we'll do some fact patterns and some solutions. I would like to put a disclaimer out there, though, is that we will be talking taxes today, and I am not qualified or trained to speak to you regarding taxation. I'm an estate planning, elder law, probate attorney. I leave tax planning for the tax professionals, but I have dissected this new law, dealt with a lot of my colleagues, and together have decided to put this webinar together to really talk about not the tax itself, but how it intersects with my client's estate planning. So again, our goal of this webinar is to discuss the intersection of taxes, estate taxes specifically, and estate planning. So we'll get started in this 6-part goal series, and the first part is as stated. What does this new exemption mean to you? The change in this law eliminates the estate tax filing requirements for decedents, and decedents is someone who has passed away, a decedent with taxable estates valued at $2 million or less, including property owned in other states. Therefore, if your estate is valued at $2 million or less, when you pass away, your estate will not have to file and will not have to pay a Massachusetts estate tax. What does this mean to you? Under the previous Massachusetts estate tax law, an unmarried person with an estate of $2 million would have paid almost $100,000 to the Commonwealth of Massachusetts upon their passing. Using the new act, that same person will not pay any tax. More significant is the benefit to married couples with estate tax planning that contains tax planning trusts, as we can now protect up to $4 million for married couples from taxation. Part 2 is estate tax planning, federal and Massachusetts, gift and estate tax exemptions. I put these two categories in two different colors to keep you geared towards thinking that there are two separate, complete categories of taxation. One is when the federal government taxes you, and it's normally a tax you pay to the IRS. The second is a Massachusetts tax, which is normally paid to the Department of Revenue. Then we have gift and estate taxes. Gift tax are for gifts made during your lifetime normally, as well as estate taxes are taxes that you paid when someone passes away. So federal estate and gift tax exemption. The annual gift tax exemption for federal is $17,000 per person per year. Many clients ask me about this gift tax and how it will intersect with their Massachusetts estate tax. But realistically, the only place you have to worry about an annual gift tax, an annual gift tax exemption is when you're dealing with federal taxes. And the current rate for 2023 is $17,000 per person per year you can give away to anyone you would like without paying any taxes on it. For the federal government, we have a lifetime and a death tax exemption of for $12,092,000. So you can give during your lifetime or upon your death $12,920,000 without paying any gift taxes. If we could all be so lucky, right? Now, that's federal. IRS, we're now transitioning to the state or Massachusetts estate tax exemption. Now, Massachusetts does not have an annual gift tax exemption like the federal government has. We do not have a gift tax, so you can gift an unlimited amount of money during your lifetime and not be taxed by the Department of Revenue in Massachusetts. So we have no annual gift tax exemption. We don't have a lifetime gift tax exemption of giving money away during your lifetime in Massachusetts. But we do have a death tax exemption, which is what this webinar is all about, right? It's the $2 million estate tax exemption that we are now able to give away up to $2 million upon our passing without paying any estate taxes. Section 3, the new Massachusetts $2 million estate tax exemption. Some key elements of the new Tax Relief Act that you should be aware of. As we've been talking about, we have the $2 million estate tax exemption, and we've been waiting for this for many years. For many now, there's no rush to move to New Hampshire or Florida, which in New Hampshire, we have a state death tax that is coupled with the federal rate of $12.9 million. Florida has an unlimited exemption. So where Massachusetts was so low previously at 1 million, a lot of my clients were actually thinking about relocating to a state with a much better state tax threshold so that they would not have to pay estate taxes upon their passing. So this new law creates a $2 million exemption. We did ask for 3 million, but we received 2 million. This is a different type of tax than the 1 million exemption that we had, and that this is a true exemption, not a tax credit, but a tax exemption. And I'll go into that in a little more detail in the next couple of slides. Also, this act is retroactive to January 1st, 2023. Therefore, if someone you know passed away and had an estate tax to pay after they passed away from January 1st to present, and they paid an estate tax, then they should be asking for a refund and a refiling of that estate tax. So this is a very nice feature for many people that thought they had an estate tax for someone that died on January 1st, 2023 or afterwards. Another element of this Massachusetts Tax Relief Act that we are not going to speak about too much is that it lowers the Massachusetts short-term capital gain tax rate from 12% to 8.5%. The long-term capital gain tax remains at 5%. And another element that some of my clients were happy about was that it increases the maximum senior circuit breaker credit from $1,200 to $2,400. But again, our webinar today is going to focus solely on the $2 million estate tax exemption. Let's talk old and new so that you can understand how this is a benefit and how it intersects with your estate. So the old law said if your estate value exceeded $1 million and you were taxed on everything from $1 up, resulting in a $36,500 tax on an estate valued at $1,100,000. So 1 penny over 1 million after exemptions, you had to pay $36,500 tax. Now, under the new law, if you have $2 million or less, there will be no tax. And unlike the old law, if your assets are worth more than 2 million, there is an estate tax, but only on the amount over the 2 million, not on the entire amount. So conversely, where we were being taxed above on $1,100,000 because we were 1 penny over the $1 million exemption, we are now going to have a lower tax burden to pay, because even if we are over 2 million, say if we're over by $100, we will only pay an estate tax burden on that $100 that we are over the $2 million threshold. This is good. And this is referred to as a true tax exemption, not a tax credit, which is how we get to the full $2 million being exempted. It's a win, especially if you plan. But do you need to plan? And by plan, I mean estate plan. Consider if your estate would be close to the $2 million exemption upon your passing. If you're fortunate, it can be easy to reach the $2 million threshold. So here's an example. Your primary Massachusetts residence might be 500,000, maybe a million, but we're going to use 500,000 for this example. A second residence you might have at another 500,000, an investment account at 250, bank accounts totaling 100,000, retirement money at 500,000, life insurance policy at 200,000. That would give you a total estate tax threshold of $2,050,000. That would put you over the Massachusetts estate tax threshold, and you would need to pay an estate tax on that amount. So let's go into the strategic planning and estate planning with trusts. So we're going to talk a little bit about taxes, but very briefly, because in order for you to understand how the exemption intersects with your estate, we need to talk a little bit about estate taxes and portability. So again, I have differentiation between federal taxes in blue and Massachusetts state taxes in green. So the federal government has a 12.92 million exemption. And the federal government allows portability. What is portability? Portability allows a surviving spouse to use up their deceased spouse's federal estate tax exemption, even if they didn't have a tax savings estate plan in place when the first of them passed away. So portability is something that we use very often in estate planning, and especially taxation on a federal basis, that if someone had passed away and we wanted to use up some of their exemption so that on the surviving spouse, when they passed, they didn't have a tax to pay, then we would use portability to accomplish that. Conversely, Massachusetts has a $2 million exemption, much lower than the federal 12.9 million, and we have no portability. So Massachusetts having no portability is that portability is not available between spouses under the state tax exemption of $2 million. Not that as an organization, we didn't ask for portability to be included in the new act, but we didn't get it. So from portability, If we have portability, it's very helpful in that same situation. Let me go back to the previous screen. As that we use portability in the federal taxing scheme to move some of the taxes out of a surviving beneficiary's estate, a surviving spouse's estate, so that when the surviving spouse passes, they are not going to be taxed. Now, in the federal area, we have a $12.9 million estate tax threshold. So it's, for me and for most of my clients, it's not that important to have portability in that very large taxing threshold. Conversely, in Massachusetts, where we have a $2 million threshold, if a client of mine passes away, maybe a married couple with $3 million, and we did not do any estate tax planning, then there is no way for me to use up any of the deceased spouse's estate tax exemption. And so $2 million exemption is wasted, and the surviving spouse now has a $3 million estate that they have to actively work on getting down to below 2 million before they pass. Using the Massachusetts $2 million exemption, how can you do it? If you're individual, estate and tax planning is accomplished by lifetime gifting or charitable gifting or giving. So that's how we're going to use that $2 million exemption, by getting our estate below $2 million. As an individual, we're going to use lifetime gifting or charitable gifting during life or upon your passing. Now, marital estate tax planning is accomplished with credit shelter tax trusts. That's a substitute for portability. Lifetime gifting, as above. Disclaiming is another aspect, and charitable giving. So we're going to keep our focus today primarily on credit shelter tax trust planning, which is a substitute for portability. So tax or credit shelter tax planning trust goes by many names. It is referred to as tax trust, AB trust, credit shelter trust, marital family trust exemptions. In all of them, because they're really all the same, our goal is to ensure when the second spouse passes away, that their estate is under the $2 million exemption, so that there is no Massachusetts estate tax. We use tax trusts because Massachusetts has no portability. Therefore, for married couples with over $2 million, the first spouse to die must do the following to use up their $2 million Massachusetts estate tax exemption: by passing assets worth $2 million to individuals other than their spouses, or to certain types of trusts for the benefit of the surviving spouse or other individuals, or the deceased spouse's exemption will be lost. Section 5. Do you need to change your current estate plan? Well, in order for you to answer that question, first you need to evaluate your current plan. Second, evaluate your total net worth. Third, evaluate your goals. Do you need to change your plan? Maybe. If upon your passing you don't have and don't expect to have over $2 million, including life insurance, then for Massachusetts estate tax purposes, a change is likely not needed to your plan. Although many married clients still wish to have tax trust planning in the event that market conditions increase the value of their estate unexpectedly prior to their passing. If you don't have an estate plan that includes a trust, a will can distribute your assets upon your passing, but it is not private and it does not avoid probate. Therefore, we recommend changing your estate plan to at least include a trust. Do you need to change your estate plan? For married couples who have tax planning estate plans drafted by our firm, those plans have flexible provisions that will automatically account for the changes made by this new law. For those with tax planning estate plans drafted by other firms, especially those using a two-trust approach funded with specific assets, it may be necessary for couples to retitle assets to take full advantage of the increased $2 million exemption amount. If you are married and have or expect to have over $2 million, including life insurance in your estate, and your estate plan does not include tax planning, then you should change your estate plan to include tax planning. To hone in on some of the fact patterns and solutions, I've given you some examples. In the first fact pattern, I have a husband and wife with the following assets. They have a house in Burlington worth $750,000, a house in Cape Cod worth $1 million, bank accounts $50,000, investment accounts $500,000, and life insurance $500,000. Their total net worth is $2,800,000. Would this married couple benefit from estate tax planning? Yes. A tax planning trust would ensure that on the second spouse to pass, their estate would be under the Massachusetts $2 million exemption, resulting in a Massachusetts estate tax savings. This couple should have an estate plan that includes tax planning. Fact pattern number 2, husband and wife with the following assets. Everything the same except they don't have a vacation or a second home in the Cape. So their assets are down to $1.8 million. Would this married couple benefit from estate tax planning? No. No estate tax would be due on the first or second spouse to pass, so no estate tax plan is necessary. Although a non-tax planning revocable living trust would ensure this couple would avoid probate while keeping their legacy private. Pattern 3, single person with the following assets. Back to kind of what the first fact pattern was with a married couple, but this is for a single person. $2.8 million again. Would this individual benefit from estate tax planning? A plan for them would be an estate tax would be due on their passing. To avoid paying an estate tax, they would need to do lifetime gifting to get their estate below the $2 million threshold, or name charitable gifts in their estate plan to reduce their taxable estate. Although a non-tax planning trust would ensure avoiding probate, keeping their affairs private, and arranging for charitable giving. Fact pattern number 4, same situation except no second home. Their total estate is now down to $1.8 million. Would this individual benefit from estate tax planning? No estate tax would be due on the passing of this individual, so no estate tax plan is necessary. Although a non-tax planning revocable living trust would ensure they would avoid probate while keeping their legacy distribution. Conclusion, a few takeaways from this webinar, and then we'll move on to questions and answers. Key takeaways are $2 million estate tax exemption is a big improvement. For many, there's no longer a need to move to New Hampshire or Florida, although we are still one of the worst states for estate taxation, second only to Rhode Island. You should speak to your tax or financial professional to confirm your estate tax exposure. You should speak to an estate planning attorney who can recommend specific planning to help reduce or eliminate your Massachusetts estate tax exposure. While you may need tax planning or not, whether you need tax planning or not, a will does not avoid probate, so consider trusts as planning, as part of your planning. And have a happy Thanksgiving. What next? Evaluate your circumstances from a monetary perspective. Consult with an estate tax professional. Consult with an estate planning attorney. And now we're going to take some questions and hopefully I'll give you some answers. I had one person that sent a question in advance. And that question is, if I am a single individual, they are, and they have $2,100,000 when they die, do they need to do tax planning? Well, first of all, for an individual, You really have to rely on lifetime gifting and charitable contributions to do tax planning in Massachusetts to get you under that $2 million threshold. So if you have not calculated what some of your maybe estate administration expenses might be upon your passing, and you're only $100,000 or $100,000 over the exemption amount, you might want to count on how you can get your estate below the $2 million threshold, such as if it is $2,100,000, that we need to deduct the cost of your funeral, possibly. We could also reduce your estate by the amount it does cost to do your trust or estate administration upon your passing. And those expenses often get you below the $2 million threshold. But it is extremely important to know that even if you are over the $2 million threshold, but have deductions to get you below, you will need to likely file the tax filing and then show that you are over, but have no tax liability to pay because you have expenses that you can reduce or take off your tax that might be. Another question was, is portability going to be an option in Massachusetts anytime in the near future? I do not see that happening anytime soon. Will it really help me if I move to New Hampshire if my estate is over 2 million? If you're thinking, will it help you from not having to pay estate taxes upon your passing? Yes. If all of your assets are located in New Hampshire and that your estate is under the federal rate, then there will be no estate tax to pay. The last question I have is it true that the federal rate of $12.9 million is likely going to be reduced? Yes, there is talk on the block that at the end of 2025, beginning of 2026, we are going to be looking at the federal exemption rate coming down probably to at least half of what it is now. But that's all speculative, but for years they've been talking about getting it closer to the $5 million threshold. So that about wraps it up for me. Thank you very much for attending the webinar. If you have any questions or you need an estate plan that includes tax planning or probate avoidance planning, I'd be happy to help you. You can reach out to us at 781-229-0555. We have links on our website, guthrolaw.com. We also have a lot of videos and educational videos and resources on our website that help clients and prospects the same to try to understand estate planning, probate, elder law issues in more detail without having to incur the expense of an attorney or to pay for a consultation. And you can also email us at office@guthrolaw.com, and our staff will be happy to respond to you by sending you out an estate planning questionnaire. Put down all of your assets. You can send that back to us, and then we can set you up for a Zoom or in-person no-charge consultation for estate planning. And as I said earlier, we'll be sending you a coupon for $200 off an estate plan if it includes estate tax. Thank you all very much. Look forward to hearing from you. And we'll also send you a summary of what the key points of this webinar were all about. Thank you very much.
If you would like help or have questions about this information, please give us a call at 781-229-0555 or visit our website at guthrolaw.com. We look forward to hearing from you.